In this video, I wanted to kind of discuss something that I've been noticing recently, or even when I even started investing. And it's kind of the idea of, think about this, when you first start investing, right, or trading or something and looking into the market, you might notice that you'll get into a stock, and whatever stock it is, it doesn't matter. And you might be buying, and you're thinking the first thing you're thinking about when you're getting into the stock is that you're gonna make a quick buck or something like that. I'll get in, I'll get out, make a couple $100 or double my money or whatever in a short period of time, and then later on, you're gonna keep moving on and try to build up your pile of cash. So what people do, and I'm kind of guilty of this, what happens is you'll get into a position and something will happen, maybe some news or something, market correction, and and then the stock that you're in tanks, and then later on, now what happens is you're stuck in that position. So instead of making quick, a couple $100 or something like that, you're kind of stuck in that position. You might be down 10%, 20%, or 40%, whatever it is. And what most people do is that they change their mindset and they'll be like, okay, well, I'm just going to be a long-term hold right now, so I'm going to switch it to a long-term hold. And what people will do is they'll just kind of back hold it, and then later on, it could last for months, days, weeks, a year, who knows. Then later, what will happen is that they're down in a position and they kind of get discouraged, as it continues to get longer, especially if it goes for 6 months, 9 months, a year, or something like that. And what people will do is that they'll try to convince themselves, oh, this is a long-term hold, and maybe sometimes the stock might go up, maybe to a certain point, and you might be profitable, but then later it drops again, and then later now you're wishing that you would sold, even if it's just to break even. Or sometimes people will get to the point where they're kind of sick of looking at their portfolio and they're like, hey, you know what, I just want to break even on the stock. And then later on, they might be able to get to the break even point, sell it, and then later what happens, the stock shoots up and doubles, and you kind of regret and hope that, and you would mention that, like, oh, I should have held on to that stock, and vice versa and stuff like that. So what do you do? Like, so how are you supposed to handle this and stuff like that? Well, you have to, when it comes to stock, it depends on what you're doing. So you have to think about it like, are you an investor or are you a trader? That's the main thing. Before you buy any stock and stuff like that, you should be able to think about, like, okay, what am I supposed to do? What's my goal? Is it short term? If it is, and it goes against you, then you should be able to think about it like, okay, before I buy this stock, if it goes down, 10%, 20%, or whatever, you should have an entry plan and an exit plan. So if you're like, hey, if it drops down 20%, I'm going to cut my loss, even though you might feel guilty or bad because you lost money, but it happens. So you have to kind of think of it like that. If you're an investor, that's a different story, because the difference between an investor and a trader is that an investor wants the stocks to go down. Like, if I'm buying a stock and I'm looking into the stock, and for me it's a long-term hold, then I want the stock to go down. I don't want it to go up. The reason why is because when it goes down, then I could buy more and I could build up my position and stuff like that. And if I do my research correctly, I'm not worried about that. I'm not worried about, hey, this company was going to go bankrupt or something. Could it happen? Yes, it can. That's the risk that you're going to have to take. And especially if you're going to do your research and stuff like that, you have to understand that that's something that you're going to have to calculate in there. So that's something that you should be aware of when you're looking into stocks and stuff like that. So as an investor, you want it to go down because, like, for me, I want to build up a bigger position. So the stocks that I'm looking into, I know that, hey, the fundamentals are good. You look into the management is good. and then learn also you look at the balance sheets and everything like that, and if they're good, then yeah, I want to continue buying. But if the company's story changes, let's say they start to pile on more debt because of whatever happens, and they're like, hey, we have to, pile on more debt. Well, the story changed for the company, so if the story changes, then I might have to exit out the position and sell it for a loss. But that's okay, because you you'll you won't you won't like be 100% right all the time. You what you want to do is the odds of you being correct should be more than the times that you are wrong. So, and you have to look at the risk rewards and stuff like that when you're investing into a company and stuff like that. So like that's something that you'll keep that in mind when you're investing in stocks and looking into a stock and stuff like that. But as a trader should have a different mindset. So you should be able to like look into your position and be like, okay, this is the entry, this is how much I want to that I'm gonna buy in. This, if it hits this price, I'm gonna sell. So if it's 10%, 20%, or even if you're day trading that day, you're like, oh, if it hits this, I'm gonna take my profits and go. And you might hear people saying like, well, should you buy, should you sell, should you add your position if it's uptrending, downtrending? It just depends on your style of trading. And if you're trading, then what your goal is to make quick money and to build up your position. And then later on, if it goes against you on that trade, then you want to set a stop loss. So you're going to set a stop loss before you get into that position. So you're like, okay, if it go down 10%, I'm going to hit stop loss, and then later on, once it hits that, I'm out of that position. Whereas an investor is different. They want it to go down so they can build up their position and stuff like that. So what is the difference between that? There are differences when it comes to stocks when you're doing trading and you're doing investing. Okay, a lot of people that I notice when they do trading, they'll actually look at companies that are like, they don't understand the fundamentals regarding when it comes to when you're doing a trade, because they don't care about that. They're looking at the technicals and stuff like that. And one company I want to provide an example with is SNDL. I've seen this a lot of people on a lot of Reddits and stuff like that. When people ask, people would say, hey, go buy SNDL, you'll thank me later, or to the moon, or whatever. But if you're a trader, that's fine. That's okay if you want to trade this. But you should be able to understand that if it drops below a certain point, you should set a stop loss, because you won't lose so much capital and stuff like that. But if you're an investor, then you don't want to invest in stock. Why? Let me show you. So if you look at the fundamentals of this company, the financials and stuff like that, look at the revenues here. At 2018, there's zero revenues. In 2019, you have 75,000, 60,000 in 2020. Okay, and that's in total revenues. And if you look at the EBITDA here, there's no EBITDA, so it's not profitable. So in other words, they're not even close to profitability. So the odds of me wanting to invest in this company, because I see a lot of people when they got into the stock to trade, and then later on, I noticed that a lot of people on the forums are like, oh, I'm holding this long term, they have good fundamentals and stuff like that. But if you look at the balance sheets and stuff like that, I wouldn't even hold this stock for a long time. Why? Because they're not even profitable. Look at the cash flow, they're negative year over year. Okay, so when you look at this, when I'm looking at this, I'm looking at the risk reward. Okay, what's the risk reward to this if this is a long-term investment? It's not. I wouldn't even touch this, because I'd rather wait until this company proves itself, becomes profitable, then I would invest in it, even though the stock price would be higher, but I'm reducing my risk. So if you look here, down here, look at the free cash flow right here, and it's negative 12,000, negative 250,000, negative 60,000. So they're not even a profitable or anything like that. So as an investor, I wouldn't touch this stock as an investor, because you know, they're not profitable. They're not, I don't see them growing or anything like that. Could it change in the future? Sure, it could definitely change in the future, but I'd rather wait, put this company on my watch list, and then I come back to it and wait and see until they prove themselves to be growing and to be a growing company, rather than get into the trade, it goes against you, and then you're back holding it for months, years, and who knows if it would go back to, you know, to the highs that they have. You know, who knows? So, because if you look at this here, look at this right here. On February 10th, it went to $2.95, right? And then later it kind of went down, 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 and now it's at 67 cents. Will it go back to the $2 to $3 range? It might, you know, it could. I'm not sure, but you don't know when. You don't know when, and so if you don't know when, if it's going to go back up and you're back holding it, what if you're back holding it for 6 months, a year, 2 years? You know, you're tying up your capital and pretty much unsure when it's going to go back up to your cost basis, when you rather, you know, cut your position, cut your losses, and maybe like invest into a better company, you know, that will be like, that, you know, could grow, you know, and that, and to me, that's a better use of capital. That's my opinion. You know, I rather take that money, take the loss, and look into a company that I know would grow. You know, like maybe Apple, or, you know, or any other company, or anything like that. You know, maybe like Target or something like that. Maybe, you know, yeah, these companies are bigger in stock prices and market cap or anything like that, but you know that these companies have the financials to pretty much grow, and they've proven themselves, rather than go to a company, stick with a company that has pre-revenue, and you're not sure if, you know, if they're growing, or if the stock price is going to go back to the highs that you purchased at. So so that's pretty much the difference between like being an investor and trader, and doing that, where you get into a position and then learn you know, it goes against you and you're just back holding it. To me, you'll hear people, you might hear people that state that they're like, hey, you know, should I you know, take profits, or should I, you know, don't take profits and hold for the long term and stuff like that. And to me, it depends. It depends on if you're an investor or you're a trader. Like, what are you doing? You know, you have to kind of know like what you're doing when you're getting into that position and stuff like that. If you're an investor, then that's okay. You know, if the market goes up, the market goes down, totally fine. Because then if the market goes down, you're going to add to your position. You know, the company's is strong, it's going to be there for a while, and they're growing. And unless the story changes, that's a different story. You know, for instance, you know, CCL or any of the airline stocks. Those airline stocks, you know, when COVID hit and stuff like that, they pretty much had to take on a lot of debt and stuff like that. That's why you see a lot of people like Warren Buffett, they, you know, exit out of the position because the story changed on the company. So that does happen, but that's okay. But when it comes to trading and stuff like that, what you're trying to do is you're trying to make quick money, get in and out of stocks. And if a position goes against you, then sometimes it might be time to cut that loss, and, you know, and take the hit and go into a different stock that maybe has a better chance of, you know, making you money and growing your portfolio in your account and stuff like that. So I just want to kind of discuss this, because I've seen this a lot, and I hear a lot of people saying hold for long term, and when you already know that people, they went in there just to kind of get a quick gain, like they want to make money quickly and get out and move on to the next stock, but they got back hold, and now they're stuck with holding the bag. So, and then later, so you don't even know if that company is going to actually go back to higher highs, to the high of where, you know, where it hit, or if it's going to just never get there. And then there's, so why are you going to tie up your capital for so long when you could just deploy that somewhere else? So, you know, I kind of wanted to discuss that and kind of address that, and hopefully you know, if you find that kind of information helpful, then maybe it might help you with, you know, if you're stuck with a position where, you know, you're down in your position 20-30% and you don't know if you should sell or hold on or anything like that. For me, I've done that where I've lost, you know, I'm down on a position because I decided to try, you know, day trading. And I decided, you know what, I'm just going to cut my loss, you know, even if I'm down like 10-20% or something like that. That's totally fine, because I'd rather take that money and then let put it somewhere else, and then let have in a better company, and then let grow that money and maybe recoup that loss and plus more. So hopefully you find this kind of informational, and if you have any questions, feel free to leave it in the comments below. And you guys have a good day and take care.